Welcome to Out and Out Trader, where we break down all the news, narratives, facts, and figures that matter this week, giving you a critical edge to your trading heading into this week's market action. In this week's Narrative versus Reality, we revisit the current inflation narrative and take a look at some of the goings on behind the scenes that suggest inflation may not be as long lasting as the global central banks seem to think. In News to Watch this week, we revisit our prediction of a potential housing crisis from 2 months ago and take a deeper look into Canadian and New Zealand real estate, which suggests the housing crisis has started and will be global. Highlights on the economic calendar this week include a BOJ press conference in which we will be looking for signs that they may begin defending the yen, which is down nearly 12% in just the past 2 months. And we finish off with a look at the charts and our trade of the week, which is another look at our long US dollar CAD trade from 2 months back. Let's get into it. Last week, we saw Bloomberg reporting that truck and auto sales growth were at levels only seen before in the run-up to recessions, with new truck sales down 23% on an annual basis and new car sales falling at a similar pace. The significance of heavy truck sales in the US is that they are a very good leading indicator of economic activity, and around about 65% of the dollar value of American freight is all being moved around the country via truck. So if that number drops off, if we see the lack of sales in trucks, we're seeing probably more than likely a lack of demand in the economy, and that's obviously an indicator that we may be heading in towards a recession, as we've been calling for several months now. And people may be arguing that the drop in sales is a result of supply constraints, but when we look at all the new truck fleets available for hire in the US, we can see a massive surge in available trucks. So the narrative continues to run that the US is suffering from a shortage of truck drivers, but the options available to transport freight around the country via trucks has skyrocketed, meaning the cost to do so is plummeting. We've also seen contract load volumes falling for 7 consecutive weeks, down 4.5% this week alone. And then when we look at Chinese ocean freight rates, they continue to roll over, and we see that demand dynamics are beginning to flounder globally. So even though supply constraints remain a massive issue across the globe, the cost of shipping is declining and people are simply ordering less stuff. And that's something we've been really calling for several months now. As we've always believed that these higher prices cannot be supported by the current economic strength or weakness that we've been seeing in the markets at the moment. We just have a consumer that is overstretched already, too much debt in the system, rising interest rates, which is obviously making those debt payments even more expensive. And that's obviously going to lead to a lack of demand. And those supply constraints that we've been seeing over the last months, which have been driving inflation, are going to start to wind themselves down as demand drops, and even further as those supply constraints and those bottlenecks start to clear up. So we're going to see a big decrease in prices moving forward, and we believe we're heading towards a deflationary shock, a deflationary recession around the globe. And yet when you look at mainstream media, they continue to shout about massive inflation and shortages and the coming inflationary doom, even though major commodities remain far below their 2011 highs and may even have topped out here when looking at the current level of Chinese imports in relation to commodities. As we've been saying, China is the world's epicenter of commodity demand, but given the bursting of the real estate bubble, which we've covered extensively over the last few months, as well as continued zero COVID policy and lockdowns in China, that demand is dropping off of a cliff and looks set to take commodities with it. But 2 months ago, we warned of a potential housing crisis that was brewing as a result of all the rate hikes that we were seeing across the globe. And this week, we've really started to see cracks showing in the real estate markets. In that episode, we discussed that when we look at a year-on-year change in the house price index, we see that historically, every time the year-on-year change exceeds 10%, meaning basically, if you're seeing your house price value going up by more than 10% a year, the following years usually see prices tumble, and then that usually is followed by a recession. And that's, I believe, exactly what we're seeing this time around. On Tuesday, Canada's financial regulator said that a housing market downturn in Canada is among the biggest risks facing the financial system this year. And the timing of that statement was pretty prescient, because just a couple of weeks back, we started to see figures coming out of Toronto that were showing a good 10 to 15% decline in house prices across multiple suburbs in the past 3 months alone. So that's a massive year-on-year change to the downside, never mind to the upside. So Canada is particularly susceptible to a crisis as a result of private debt to GDP figures that are in excess of 300%, double the amount of what is considered to be the danger zone in terms of private debt to GDP. And the private debt to GDP is so important because as interest rates start to climb, the cost of servicing that debt for households becomes more of a burden on their monthly balance sheets. And obviously that starts to kick in terms of demand, because they can't afford as many goods. And that's when we start to see kind of constraints in the banking sector, constraints in terms of debt. People struggle to paying back those loans, and then we start to see crashing prices as they try to get out of those loans by selling their properties, which obviously leads to a massive tumble in house prices, and then eventually that lack of demand also leads to a recession. Canada is not alone here, as housing prices in New Zealand paint a similar picture. They were down 4.3% nationally and 7.8% in major hubs of Auckland and Wellington over the past 3 months as well. And although not as bad as Canada, New Zealand also sits in that 150% private debt to GDP danger zone, leaving it highly susceptible to a banking crisis and a severe recession as rates rise. When we look at the US real estate market, existing home sales continue to roll over, currently sitting at the same levels that we saw back in 2017 and in a strong downtrend since their peak in October 2020. And when we head over to China, we are seeing even worse things happening there. We're seeing home sales plunge 47% despite government support, according to Chinese news outlet Caixin Global. We've been warning about that Chinese real estate bubble bursting for many, many months now, and that's really starting to play out into the Chinese economy, into the global economy, and that's exactly why we believe we're seeing Chinese imports on the decline. Basically, what we're saying is that less homes sold means less stuff needed to fill those homes. And as we've been warning for some time now, and as we discussed in news versus narrative, the demand side of the equation is starting to come into play, and things are not looking good for the global economy. All that being said, if you're looking for a place to park your money through all of this turmoil, our investor guidance service will help you do just that. We're currently running a special offer on annual memberships, and you can find the details in the link below. In the economic calendar this week, we have the French election occurring, which may have big impact on the euro as we look at Le Pen versus Macron. If Le Pen comes into power, we obviously see that big move towards the right, which may have some very, very bad consequences for the euro moving forward. We also have US durable goods orders and US new home sales, obviously a big indicator to what's happening in the US economy. We have CPI figures coming out of Australia, and the big highlight for us this week is going to be the Bank of Japan's interest rate, and most importantly their press conference, because when we look at what's happening with the yen has been blowing out in a big way over the last 2 months, weakening in a big way, and we're looking for signs that the Bank of Japan may start to defend the yen. And if that is the case, we are going to be looking for some strong yen trades in our trading academy and in the trading side of the business. German inflation figures also coming out on Thursday, as well as US Q1 GDP figures. And then Friday we have US durable goods orders, another indication for the US economy, and EU Q1 GDP figures also coming out on Friday. So for those of you that have been following us for some time, you know that we've been very bearish the US dollar CAD for some time now, especially since we bottomed out at that 3rd of May 21 time period. Since then, we've been in a little bit of a consolidation. When we zoom into the daily chart, you can see that what we've had here is a long drawn out corrective structure that's just looks ready to break to the upside, and that's exactly what we've seen over the last 2 days, the big move to the upside. For those of you that were part of that video where we were looking for that long US dollar CAD trade 2 months ago, we were trading that up to those highs, and we did say watch for a deeper pullback. And once we get that deeper pullback, it will confirm this bigger triangle corrective structure that will eventually break strongly to the upside, and that's exactly what we're seeing now. So this week we'll be looking for entries in this region, looking for that long trade to the upside, which will have us pushing prices the very least up towards kind of 136, but more than likely when we go back to that higher time frame structure, you'll see how those prices are going to be pushing up way beyond the March 20 highs that we saw at that 146.80 level. And from there, we could get as high as probably around about the 173 level, especially if we had that housing price, house crisis forming in Canada, as we've been covering for this episode, and if we see that debt crisis start to come into play in Canada. So this week, US dollar CAD long will be on our radar, and we should expect some really good returns there moving forward. So as you can see, there's lots on the radar this week, a lot of things happening in the markets, and we believe we've reached a very critical point across all these charts. We're seeing some serious price action happening across the board, which is very indicative of volatility across the board, which is again very indicative of a potential change in narrative that we've been waiting for the last few months, and we'll be watching those charts with wide eyes moving forward. Cool guys, hope you've enjoyed this episode. Thanks for watching. Please subscribe for further updates, and you can also get these videos straight to your inbox. You can sign up in the link below. You can find that in the bio. Thanks guys, hope you have a great week. Members, we will see you in the members area for tomorrow's trading strategy session, and we look forward to another great week of trading. Cool guys, have a good one.